All right, all of this, the backdrop of the Fed meeting on Wednesday, at which we could determine the next move on the part of the Federal Reserve to raise or hike. I'm just, curious what Ted Weisberg makes of this at Seaport Securities, because, Ted, you could argue in the face of these more generous labor agreements of late, I don't know what will happen here, but let's assume at a minimum these guys do get a 20% pay hike. It'll probably be more than that. Could you ever envision the Fed doing a preemptive strike ahead of something like that?
No, I don't think so, Neil. We clearly have a chicken and egg problem here, and it gets back to fiscal policy and monetary policy. You have the White House basically encouraging the labor unions to ask for more money, and then on the other end of the spectrum, you have the Fed raising rates to try to put a lid on inflation. Then clearly, whatever comes out of this UAW strike is going to be inflationary. Eventually, we'll all pay the price. The price of cars are going to go up, so forth and so on. So, no, but the answer to the question is I don't think the Fed will be preemptive, but I think what it does tell us is that they're fighting a losing battle, because you have all this fiscal stimulus, whether it's through labor contracts or just the government spending money on whatever they spend money on, and the Fed trying to put a lid on things. And the end result is, at least for us, is I think we're going to see interest rates stay where they are and probably work higher. So it won't be a preemptive strike, but you can be pretty sure they're going higher as a result of all the increase in the wages, which perhaps are warranted, perhaps not. I'm not making a case either way for that. But it's just inflationary, and it's going to filter its way through the entire system. I mean, whether it's higher wages or oil at $92 a barrel because of maybe failed energy policies on the part of the administration, no matter what the end result is, we live in an inflationary environment, and that's going to have a positive effect on interest rates, and positive in the sense that they're going to probably work higher, not lower.
Yeah, and it's already happening today, where the 10-year note is in and out of 16-year highs. We always are looking at oil closing in on the highest levels we've seen in almost a year. Where do you see this going? Because when I quote a 10-year, I'm quoting something that the markets control, not the Fed, if you think about it. That isn't a Fed set rate. That's a market anticipation of higher rates. How much higher do you think we go? If we don't even see a move this week, do you think we're going to see one at the next meeting?
Well, of course, nobody knows the answer to that, Neil. It would be great if we did. We simply don't. But we all can see the dynamics of what is going on. And the dynamics, quite frankly, are on the side of interest rates going higher, because the Fed is basically fighting a losing battle. So I don't know where the threshold of pain is in terms of interest rates. I can remember in the 70s, because clearly I was here then, interest rates at 15, 16, 17%. Ultimately, it's going to be a problem for the stock market, of course, and that's the world that I live in.
Yeah.
I mean, now, Neil, just today, the 3-month and the 6-month Treasury auction, the 3 months was at almost 5.5%. The 6 months was slightly over 5.5%. I mean, the fact is that folks now have an alternative to equities. 5.5% risk-free, not a bad place to be while the dust is trying to settle in terms of where we're going vis-a-vis inflation and or higher interest rates.
Yeah, so real quickly, to your point, I mean, when you're getting those type of returns in what used to be 0% interest rate environment, right. With the protection and the full faith and credit of Uncle Sam behind it, that's quite alluring, isn't it?
Well, it's sort of a no-brainer. Now, of course,
yeah.
it's a market of stocks, not a stock market, as we're always reminded. And there's always something to do or something interesting. And perhaps the folks need to look at sectors and companies that can basically pass along the price increases, that can deal with inflation, and whether it's insurance stocks, maybe the growth area would be tech. A few tech names probably are still worth owning. Or energy, which seems obvious now with oil at $92 a barrel. But the fact is, for folks that don't know what to do, sometimes the best thing to do, Neil, is to simply do nothing, get out of the way, wait for the dust to settle. And a year ago, you were getting 0 on your savings, and now you can get 5.5%. Not a bad trade.
Yeah, not too shabby. Teddy, you're not too shabby. Thank you, my friend. Always good seeing you. Ted Weisberg, following all this from the floor of the big board.